Hi, this is Jason Coddington of Coddington Wealth Advisors, and we welcome you to another month of Student of the Market. This month, September 2020, we'll focus on what's happened in the stock market with relation to redemption and investors and how much money they're taking out. We'll also look at the bond market and see how much money they're putting in. And we'll also look at how August 2020 was the 8th best August on record for stocks. So please watch and enjoy. So we'll get started with this month's Student of the Market, September 2020. Some interesting things this month as we look at the behavior of stock investors and bond investors. So what's interesting, in August of 2020 was the 8th best August for U.S. stocks since 1926 at 7.2% in 1 month. So not bad. And if we look what the next 4 months hold, you can see there have been periods of time where it's been negative, and of course when it's been times of positive. If we look historically speaking over the next 12 months, the average, historically speaking, even though there's no guarantee of future results, of course you see an average of 15.4% following an August return. So no guarantees there, but it looks positive for stocks going forward. We also have some other information that in this slide that will also support that. So what's interesting though, this is important because we've gone through a lot in the past, this year, 2020, especially with it relates to the market. But if you look since January of the year, beginning of the year, the S&P 500 is up 9.7%, which is good. However, only 5 companies make up 54% of that return. You could probably get an idea of who those are. 2 of them start with A, being Amazon and Apple. So big return there, but half the return is comprised with just 5 companies. So interesting note there. So historically speaking, if we look, there are some stocks that haven't fared so well. So again, diversification is important. What's interesting though is even though the market is up, so through all of what's going on, if we look up, remember 9.7% year to date, still there's stock funds. People have been moving out of stocks into other places. So typically bonds or cash. So even with a 9.7% rate of return year to date, people have been moving money out of stocks. Therefore, the average investor isn't faring well during this time frame because they're taking money out of something that has grown and putting it into something that isn't. So we'll take a look at that in a second. So if you see, you saw massive stock outflows, so quite a bit. And then if we look at this particular side, we've had massive stock flows. So you can see the bond and stock, where it's gone just since March. So, there's been quite a lot of money moving out of the stock market into bonds. And that's interesting given our next slide. And so as of this writing, which as of today, the yield on the 10-year treasury is 0.68. And then I'm going to use this slide to explain, probably the most important slide as we're forward looking in this month of September, Student of the Market. So year to date, the 10-year treasury yield right now is 0.68%, not 6.8%. That's 0.68%. So less than 1%. So remember that. And then if we were to go forward, let's look at this graph. And what this graph is telling us is that the beginning, whatever the interest rate was beginning at 10 years later, the average return is very similar. So if we look in December of 2008, the 10-year treasury yield was 2.3. If you fast forward to 2018, the 10-year average in the 10-year treasury was 3.5%. So that's what happens when interest rates are low and then follow interest rates 10 years later. Now we can go over here to this side and show and go back when interest rates were high. So in September of 1981, believe it or not, and I was only 9, but interest rates were 15.8%. So if you take a look at that, 15.8%, if you look 10 years later, 14.7%. So 10 years later, so in 1991, the ending average return looking back over that 10 years was 14%. So what this graph is showing is that the correlation between the starting yield and then 10 years later what the average return is very similar, whether it's high in this particular case or low in this particular case. And that being said, if we're currently at 0.68%, again, past performance does not guarantee future results, but if we're looking forward 10 years to where we might be, it's not going to be a very high annual rate of return based on history for bonds. So these individuals that have taken money out of stocks and put them into bonds may, based on history, be setting themselves up for lower future returns. And lastly, what's driving this, of course, is mostly consumers' dissatisfaction. And what's interesting is that consumers are dissatisfied, they move money out of stocks and into bonds, and that typically is what we've just seen in their activity, but that typically means something positive for stocks. So there's actually a contrarian indicator of the market. So when people are unsatisfied, okay, which is you can see here. So when people are satisfied with the markets, you can see in February of 1999, 71%. That's that's the tech, almost the top of the tech, boom. And then you come back now to August 2020 with all the craziness of this year. People's satisfaction is really low. If you look at the following 12 months when people were highly dissatisfied with the market, okay, if it was less than 33% satisfied, the market typically followed with a 14.5% rate of return. So again, no guarantees going forward. However, it is very interesting to see that when satisfaction levels are low, the market even when they're over 50% satisfied, still 7.3%. And even with all of that, people are still taking money out of the market and putting it into bonds. So it'll be interesting to see what happens over the next 12 months and in the future. But most importantly is to remember to always focus on diversification and make sure that your portfolio is balanced for your goals and your needs. And thank you again so much for tuning in, taking time out for this September 2020 Student of the Market. Thank you. Thank you for tuning in for this month's September 2020 Student of the Market. We hope you found it valuable information and stuff you can use as you plan for your financial goals and if you were looking at updating your portfolio. If you have any questions about your investments or your financial goals and how these concepts may be beneficial to you, don't hesitate to contact us and we will help you out. Thank you.